Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, I want to talk about bond investing during inflationary times, specifically as it relates to Treasury Inflation-Protected Securities and I-bonds. We've had a whole bunch of questions year to date about tips and why they've fallen in value, even though we're in inflationary times, and I-bonds. I-bonds are a type of U.S. government savings bond that have been in the news quite a bit. I want to talk about when they might be a good fit for your portfolio, some ins and outs that you need to know about if you're considering them, and how to get around the $10,000 per year per person investment limitation that's imposed by the Treasury Direct website. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. All right, everybody. This week on the podcast, we're going to be doing some discussion. I will be doing some discussing, I should say, about investing in inflationary times, specifically with our fixed income holdings. I've gotten a lot of questions over the last few months about TIPS, Treasury Inflation-Protected Securities. TIPS are supposed to protect us from inflation. Why are the value of my TIPS holdings going down? Is now a good time to get in? And secondarily, we've gotten a lot of questions about I-bonds too. I-bonds are an interesting animal. And we had a guest on a couple weeks ago, Kirk Chisholm, who had some pointed observations about the economy and where we're headed. He thinks that things do not look so good. He thinks that our supply chain issues are going to take 3 to 5 years to resolve themselves. I don't know that I believe everything that Kirk had to say wholeheartedly. I don't think it's as negative a picture as he paints it personally. Nevertheless, we are seeing inflation right now, and that warrants a deeper discussion into investing in inflationary times, specifically as it relates to bonds and fixed income. So that's what I'd like to cover in today's episode. Now, I have been sick recently. My whole family got COVID here about 2 weeks ago. We had a nice vacation to Alaska, to Anchorage, where I grew up. We jumped on the airplane to come home and contracted COVID on the way down. And it knocked all of us out here for better part of 3 or 4 days each, and now and we're still trying to recover. So last week's episode, if you caught that one, we had a guest on, Brad Baldridge. He did great. I did not do so great because I was very fatigued and still under the weather, although I did the interview anyway. So at any rate, I'm recovering now. I feel fine. We're still in the period where we're supposed to isolate according to what the CDC says, but that will expire tomorrow, and then we'll be back out into the world. But at any rate, I'm feeling better. Everybody's healthy in my family. We're doing fine, but I'm still working from home, which you can probably see if you're watching the video as opposed to just listening to this. And the sound might even look a little bit different too. At any rate, let's talk about inflation in bonds. Now, I think the number one question that we've probably gotten on this subject is, Grant, you've been telling us for a long time that we need some exposure to TIPS in our portfolios. I thought TIPS were supposed to protect us from inflationary pressures. Inflation is up, but the value of my TIPS are down. Why is that? And let's start today by an explanation of what this security is and why it should be in our portfolio in the first place. So if we're going to allocate anything in our portfolio to bonds, I would argue that it makes sense to have at least a little bit of that bond allocation in U.S. government debt. As you know, we finance a lot of debt as a federal government to pay for our stuff that we want to do, right? And anytime that we want to spend money in the federal budget that exceeds the amount that we're taking in from tax receipts, that money has to come from somewhere. So the Treasury Department goes out and borrows a bunch of money from the markets. And a lot of the lenders are institutions, other countries, mostly U.S. Investors like pension funds, endowments, and individual investors like you and me. Now, we're not the ones directly giving money to the U.S. government. The way it works is the brokerage system in Wall Street will be the lender. They will give cash to the federal government in return for bonds, basically an IOU. And then they take those bonds and they distribute them out through the capital markets, through the system. And that's when it falls, and that's when those U.S. government bonds make their way into our accounts, either through a fund manager like a mutual fund or an ETF, or directly into our investment, brokerage, retirement accounts. Now, I think that it's important to have some of our bonds in U.S. government securities because it's as risk-free an instrument as there is, really. And a lot of financial theory is based upon what's called the risk-free rate. In other words, if we're going to lend to the U.S. government, what rate might we get in return for that? Now, you might argue that U.S. government debt is not totally risk-free. There are, like any investments, there are risks to it. If you could changes in interest rates, the U.S. government could theoretically default on its debt, although I don't think that's ever going to happen because guess what? We control the printing presses and we can just make more U.S. dollars if we really needed to for the purpose of paying back these IOUs, these bonds that we use to finance our domestic spending. So at any rate, it's a very low risk kind of security. We give money to the U.S. government. They promise to pay us a little bit of interest. And then at some point in the future, they give us the money back that we loaned to them. Now, typically, U.S. government debt is structured by paying making semi-annual interest payments that are fixed. So the vast majority of U.S. government debt, let's say the 10-year U.S. government bonds, the government might borrow money from these issuers. And again, that starts with Wall Street brokerage firms who then turn around and sell these bonds to fund managers and to you and me. So the U.S. government might take that money and promise to make semi-annual interest payments of, over 10 years. Right now, the yield's around 3% per year. So that means that if you're a lender to the government, you might give them $1,000, and every year the government's going to pay you 3% on that loan. That's where the market rate of interest is right about now as I record this. And that 3%, or that $30, 3% of $1,000, is structured into semi-annual payments. So for 10 years, every 6 months, you're going to have $15 deposited into your account. And then when the 10 years is up, you're going to get your $1,000 back and the deal will be over. You can take that and reinvest it in another U.S. government bond if you want to, or do something else with it. Now, Treasury Inflation-Protected Securities are a different type of U.S. government debt. Same type of setup. Investors lend money to the U.S. government over some period of time, and the term structure for these things, or how long the maturity is, varies. They issue Treasury Inflation-Protected Securities over 30 and 90-day increments. They go all the way up to 30 years. You can go as long or as short as you really want to. The reason that they're called inflation-protected securities is that the amount of interest that you get is dependent on inflation. So you might start at 3% per year. If you buy a $1,000 U.S. government bond, you might get $30 a year in interest. But that $30 in interest, or that 3%, adjusts based on the rate of inflation. So if inflation goes up, you're going to get more than $30 a year in interest. If it goes down, you'll get less. And the way the mechanism that's used to track the instrument is the consumer price index. And this is the government organization. I can't ever remember which department it is. I think it's the Department of maybe Labor Statistics. Kirk Chisholm a couple weeks ago corrected me on it. I can't remember which entity it is. But basically, there's a branch of the government that goes around and tracks a basket of goods and services that everyday people would typically consume in a given month. And they use that as a benchmark for inflation. So if in 1 month it costs $2,200 to purchase this basket of goods and services that consumers would typically buy, and then the next month it costs $2,300 to buy the same stuff, then inflation would have gone up, right? The price of those things goes up, which means that there's inflation present. So they back that into a rate of inflation, which triggers a change in the interest rate that you get through these bonds. Now, the CPI omits food and energy. And you might think, well, those are pretty core pieces of the stuff that I spend money on. Doesn't that mean that that this is not a great measure of inflation? Well, you can make that argument. They're not omitted because the government is stupid or this is frivolous. Food and energy are omitted because those prices are volatile. They bounce around a lot. And it's hard to get a reasonable measure on inflation if you include them in the CPI. Nonetheless, it's a reasonable measure by most means. If you're going to track inflation over a really long period of time, CPI is a reasonable way to go about that for all intents and purposes. So for Treasury inflation-protected securities, generally, I think that most of us should have some of our bonds in these instruments because we don't know what inflation is going to do. Right now, we're in an inflationary period. The Federal Reserve is trying to raise rates as aggressively as they need to get in front of inflation because of these supply chain concerns that we have. And for that reason, this is a helpful instrument to have in your portfolio. If you had an ordinary U.S. government security, you have the exact same amount of default risk as a Treasury inflation-protected security because your loan is to the U.S. government. Regardless of which security is, the likelihood that you're not going to get your money back or your $1,000 at the end of the 10 years or 15 or 30 or 90 days or whatever, that risk is the exact same between these two securities. What's different is that if one adjusts for inflation, the other doesn't. So if you're someone who's an ultra conservative investor and you're trying to use U.S. government debt to structure your retirement, maybe, you might rely on those interest payments that you get every 6 months to go buy goods and services, to go fund your lifestyle. And if that's you, I would probably want to do that through an inflation-protected security, because if you do it through an ordinary U.S. government bond, you're still going to get the same $15 on your $1,000 investment every 6 months, regardless of the cost of that basket of goods and services. If you go turn around and buy a Treasury inflation-protected security, the cost of the stuff you need to buy goes up, the amount of interest goes up too. So it adjusts, right? Well, in any event, these instruments still have interest rate risk. And so some people, we've gotten questions over, the first half of the year pretty consistently. I thought my tips were protected from changes in interest rates. Why is the value of these bonds going down? And at the end of the day, the answer is that even though your tips might be reset in terms of the interest you get in inflationary times, they're tied to inflation, they still have interest rate risk. And inflation and interest rates are often relatively correlated. Not always, not perfectly, but if the market rate of interest goes up, the market value of your bonds still goes down in a tip, just like any other bond does. And so here's an example. This concept is called duration, and we've talked about it on the podcast. I have at least quite a bit in the past. So let's ignore the difference between traditional bonds and Treasury inflation-protected securities for just a moment. Let's say that you buy a U.S. government bond, you give them $1,000, you get 3% interest on that bond over the next 10 years. And then when that 10 years is up, you get your $1,000 back, right? Well, remember, 3% of $1,000 is $30. It's scheduled into semi-annual payments, so you get $15 every 6 months, and then you get your $1,000 back down the road. Well, once you buy that bond, it has a value, which is really pretty close to $1,000, right? If you wanted to go turn around and sell that bond on the open market, then the amount you get for it is going to be based on what the bond market is willing to pay. You don't have to sell it. You could hang on to it and the bond will mature in 10 years' time. But if the market rate of interest remains the exact same 3% on this type of security, then the value of your bond is going to continue being $1,000. Now, let's say that you take the $1,000 and you buy the bond, and then 2 weeks later, the market rate of interest goes down from 3% to 2%. Well, a new investor, meaning someone lending new money to the U.S. government, is only going to get 2% in return. But you're getting 3% because you got in at the right time. So the value of your bond on the secondary market goes up because your 3% is better than the prevailing 2% available in the market. And if you wanted to turn around and sell it, you would get more than $1,000 because that's valuable to someone investing new money. Now, on the other hand, if the market rate of interest goes up from 3% to 4%, now your bond doesn't look so good in the eyes of the secondary market. Other investors could go directly to the Treasury, lend them $1,000 and get 4% per year. Why would they want to pay you $1,000 for yours that's only going to pay 3%? So the market value goes down. Okay? This concept is called duration. That depression in price is temporary. As long as you hold the bond until maturity, you're still going to get your $1,000 back at the end of 10 years. You just have to wait and continue to collect $30 a year instead of $40 in the meantime. And so if you have a need for the cash and you need to turn around and sell it in the secondary market, you'll get less than $1,000 and would take a little bit of a loss on it. But if you just hang on to it, remain consistent and long-term in focus, which you should be in the first place if you're buying a 10-year bond, then you'll get your money back. The only risk is that the U.S. government defaults, and that's exceptionally low, particularly, again, because we control the printing press. So the same goes for tips. Let's say that you buy a tip, it's paying 3%, and then the rate of inflation goes up to whatever it is now, 7%, 8% a year. Well, the amount of interest you're going to get is going to go up in lockstep. If inflation goes up by 5%, then your interest is going to go up by 5%. It's not going to go up from 3 to 8, I don't believe is how it works. It's a little more complex than that. But the amount of interest you get is going to go up in an analogous way to what the CPI is doing. But if the market rate of interest goes up from 3% to 4% and inflation hasn't moved, then you have the same duration risk in a Treasury Inflation-Protected Security that you do in any other government-issued piece of debt. It's the exact same thing. The complexity here is that interest rates and inflation are often kind of related, right? Inflation goes up, so we have more interest coming off of these securities. Usually what happens is that if inflation persists, like what we're seeing now, the Federal Reserve will turn around and raise interest rates to get prices under control. And so inflation goes up, that means you're getting more interest. And then interest rates go up after that. It means that you're going to have the same duration risk as an ordinary bond. The prices will go down temporarily, again, until you approach maturity. Now, I think that anybody's bond portfolio ought to have a little bit of U.S. government securities and a little bit of tips in it just to assuage inflationary pressures. Because if you don't have any interest rate mechanism in there, then the 3% you're getting is not going to go as far over the term of your bond portfolio. It's nice to have some of the interest in your bond portfolio be tied to inflation. Not all of it, because you do pay a premium for it, but a little bit. But that's realistically the reason why TIPS funds and TIPS holdings have fallen in value. And just like any other U.S. government security, just hang on to it and wait for it to recover. This is a mathematical thing. This is not conjecture about the direction of the market. It is a certainty that as long as the issuer doesn't default, and in this case it's the U.S. government, which makes me very confident that it won't, the value of your portfolio will return. And like we've talked about on the podcast in the past, the length of time that you need to hold the bonds for is called the Macaulay duration. You take the average duration of your bonds, which is the weighted average amount of time that it takes the cash flows to total your investment. For most bond portfolios that we see, it's somewhere around 5 to 8 years as an average period of time. Just hang on to it. Prices will recover. And as long as you're long-term in focus, I have a whole lot of confidence that as long as your bond portfolios are not invested in a bunch of junk, that this is a temporary kind of thing. So that's the messaging on TIPS. The other thing that people are asking about that's been in the news quite a bit over the last 6 to 12 months are I-bonds. I-bonds are another type of U.S. government debt, but they're a lot different than the debt we've just been talking about. An I-bond is just, think of it as a U.S. government savings bond. U.S. government debt, like 10-year notes, 10-year bills, up to 30-year bonds, those all trade in the secondary market. The Treasury goes and borrows a bunch of money. They go to the Wall Street network of broker-dealers who subsidize the bond issues. Basically, they buy them first, and they turn around and sell them to their customers, pension funds, endowments, ETFs, mutual funds, investors like you and me directly, right? A savings bond is one where you and I go directly to the federal government. There's a website. It's the Treasury Direct website. If you've ever been on it, it looks like a scam because it's such a visually unfriendly website. It's about 20 years old. It is secure as far as I know, and it's the legitimate Treasury Direct site, but it just looks really poor visually. But at any rate, with savings bonds, you and I go directly to the federal government. There are all sorts of savings bonds that we can put money in. There are H bonds, EE bonds, a couple of other types, and then there are I bonds. And with I bonds, we can purchase $10,000 up to $10,000 worth per year, and the rate of interest we get resets periodically based on the rate of inflation. And so if you're someone who has a bunch of cash laying around and you're saying, hey, I don't really want to leave this in the bank, because in the bank, even though rates are up, I'm still only getting maybe 1% per year on my savings. But inflation is 8% plus. Why on earth would I want to lose purchasing power by keeping the cash in the bank? Well, this could be a reasonable alternative. I don't like to think of it as part of our emergency fund, and I'll get into that here in a few minutes. But with an I bond, you give cash up to $10,000 per person per year to the U.S. government. In return, they pay you interest based on the CPI. So right now, you get, I think the most recent update is paying like 9%, a little more than 9% per year. And that interest rate adjusts again every 6 months, I believe, with new CPI numbers. The CPI is published every single month. I believe that I-bond interest only adjusts once every 6 months. So right now, if you go to the Treasury Direct website, you get a rate on this money of 9% plus. You cannot redeem the bonds for 1 year. And remember that these are direct investments with the Treasury. They don't trade on the secondary market, so it's not like you can sell this note to somebody else. It's in your name and it stays that way. So you cannot get your money back for the first 12 months. You can hang on to them for as long as 30 years. Once you hit 30 years, they mature on their own, you get your money back. Okay, so the term is anywhere between 1 year and 30 years. But it's meant to be a longer term holding. And if you redeem them between 1 and 5 years away, so you cannot get your money back within 12 months. If you do redeem after that initial 12 months, there's a penalty. You pay 3 months worth of interest to redeem within the first 5 years. So realistically, that can still make sense because you're still getting a lot of interest in this inflationary environment, at least. And maybe foregoing 3 months worth of interest isn't the worst thing in the world. But in general, we want to think of this as long-term holdings. Now, for most of our clients at the firm, I haven't really overtly recommended this because of the $10,000 limitation. Okay. For a lot of investors out there, being able to put $10,000 a year into this is a lot of nuisance for the amount of extra return we might be able to squeeze relative to the rest of their portfolio. It can still be helpful to a lot of people, but the $10,000 is a limitation. Now, you could leg into this every single year and renew your investment if you want. And for households, excuse me, there are ways to get more than $10,000 a piece in it. The $10,000 limitation is a limitation for that registration of ownership. So you and I as individuals cannot invest more than $10,000 a year in these things. But if you're married, you could put $10,000 a year in for yourself, another $10,000 for your spouse, and then a third $10,000 for you two jointly, which is a third type of titling, a third type of registration. If you've done some estate planning and have a trust, maybe another $10,000 a year in the name of the trust. It gets you can go as far down this whole rabbit hole if you as you want. And again, for that reason, the $10,000 increments are a little limiting, and it requires a fair amount of extra work to get a reasonable holding in I-bonds. Now, the other thing is if you go down that road and you have $10,000 for yourself, $10,000 for your spouse, $10,000 for your trust, and $10,000 jointly, if you've done any estate planning and have a trust in the first place, these are assets that you probably want to put in the name of the trust anyway, and it kind of circumvents all the estate planning that you've already done. Nonetheless, for people who are looking for a place to park cash and you're comfortable not being able to access it for at least 12 months, this is not a bad option. Because regardless of what inflation does, your purchasing power will be preserved because you earn interest based on the CPI, just like a Treasury Inflation-Protected Security. What's unlike a Treasury Inflation-Protected Security is you don't have the same level of interest rate risk. When you buy a TIP, you're buying an instrument that will mature at some point in the future. It could be a 90-day note, a 90-day bill, a 10-year note, a 30-year bond. It could be anything in between. Because remember, the government issues inflation-protected securities under all of these maturities going out to 30 years. But with an I-bond, that's your deal with the U.S. government. There is no secondary market for it in the first place, and you can redeem it whenever you want after the first 12 months. You can hang on to it for as long as 30 years, but you can redeem at any point. So it's a different animal. Now, I don't like using emergency fund cash and putting it into I-bonds. And we've talked about cash quite a bit over the years on the podcast too. But just to refresh everybody's memory, when we think of your emergency fund, we want to have a little bit of cash set aside for a rainy day in case you need it, so that you don't have to dip into your investments and your retirement accounts at an inconvenient time when the markets might be down. And the right amount of cash to hold on the sidelines is typically a function of your living expenses. On the short end, maybe as few as 3 to 6 months in some cases. Some people need to have as much as 24 months or 2 years worth of cash, just safe and liquid for a rainy day in case something happens. The rules for where we park that cash, yes, we're trying to get the best yield on it that we can. And it doesn't feel very good right now to have the cost of everything that we're buying go up at 8 or 9% a year and have our cash savings only earn 1% per year in a high yield savings account. That doesn't feel good. But it needs to be accessible and it needs to be liquid. And so money market funds can sometimes be a good destination for this cash. I like high yield savings accounts quite a bit. Capital One, Ally Bank usually offer pretty competitive rates. You might have a local credit union that does a good job of offering a competitive rate, but it defeats the purpose of having the emergency fund in the first place if we put all of it in I bonds that you can't access for the first year, right? The whole purpose of this is so that you don't have to dip into your investments at an inconvenient time. If you're taking $10,000 or $40,000 a year or whatever and parking it in I bonds to squeeze more interest out of it because we're in an inflationary time, what happens if you need it 3-4 months down the road? That's why you saved up the cash in the first place, is to prevent you from having to dip into other assets. So if you have extra cash beyond your emergency fund, or let's say that you're someone who is targeting 24 months worth of living expenses as your emergency fund, well, sure, you could put anything in excess of the first 12 months in I bonds. That wouldn't be a bad way to go. But after that, I don't think I'd want to use cash that's meant to be earmarked for living expenses over the next 12 months. I wouldn't want to lock it up in anything that I can't access for a year, right? That totally blows up the whole idea. So in general, these things can be helpful to people, but it really comes down to what your cash needs are, what the size of your emergency fund is relative to those targets and those cash needs, and what the rest of your portfolio looks like. I do think that everybody should have some of their bond holdings in TIPS. Probably makes sense to have some in non-tip U.S. government securities as well, in addition to corporate bonds and bonds issued in other currencies around the country, or around the world, because those all add to the diversification benefits that we really like in our portfolio. But by and large, we still have interest rate risk with any bond that's not adjustable in rate. And adjustable rate bonds are just very, the market is very thin. There are not very many of those available to us as investors. So those are a few thoughts on bonds and inflation, and what's going on in the TIPS market, and when I bonds might be a good fit for you. The only other thing that I'll add is, if you're someone who's a borrower in general, let's say that you're about to buy a house or a car, or you have some other reason to borrow money, the value of debt in inflationary times goes down. Because back to our initial example, if you give the U.S. government $1,000 and they're paying you 3% per year on that money, and you get your money back in 10 years, well, what happens if inflation remains at 8% over the next 10 years? The $1,000 you get back 10 years down the road is going to be worth a lot less than the $1,000 you gave them. And the 3% interest you get in the meantime is not enough to make up for it. So another good reason to have some form of inflation-protected securities in your portfolio, but it's also a good time to be a borrower. Because if you borrow a whole bunch of money to go buy a house right now, and this is not a comment on the real estate market and whether that's, whether we're approaching a downturn then, but it's good to borrow money if the money that you have to use to pay back the lender down the road is worth less because the price of everything that we buy and sell has gone up in the meantime. I'd rather have money now than have money later, particularly in inflationary times. And because we're in inflationary times, it's not a particularly bad time to go borrow a bunch of cash. The risk obviously is if you go borrow money to buy a house, the value of that house could go down too. That's a risk. But if the value of debt is falling as well, perhaps that mitigates that risk a little bit. So at any rate, those are some thoughts on bond investing in inflationary times and some observations about where tips are at. As you know, I'm not someone who likes to time the markets, either the stock or the bond markets. I don't know which way interest rates are headed next. And just because interest rates appear that they're on the way up does not mean that we should wait to put new cash to work in bonds, because they could just easily fall. Mortgage rates fell this week because of recessionary fears. Interest rates go in both directions. So, if you're someone who's really concerned about risk, you're concerned about the markets crashing and interest rates continuing to go up, which would hurt your bond holdings, well, dollar cost average. That's a pretty good way to mitigate that risk and just spread out your investment a little bit over time. Okay, that's it for this week. I hope this was helpful to everybody, and I will talk to you again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.